to Lorenzo, our fintech specialist and B2B insights lead, for that intro, which was very useful and fitting. I'm very pleased to be joined by some esteemed panelists who will be experts on this topic, which will be fun to dive into. First of all, I'm Orla Brown. I'm head of content at Dealroom. Dealroom is a data platform providing data on startups and venture capital globally, and helping our partners, investors, corporates and governments discover the most promising startups and ecosystems. If you've got any questions during the panel, please put them in the comments and we'll try and get to those towards the end. But to kick off, I'll ask our panelists to introduce themselves. Matthew, if we can start with you.
Thanks, Orla. Thanks for having me. Hi, everyone. My name is Matthew Jones. I'm on the investment team at Anthemis. We are a venture firm focused on financial services. We have been up and running for the best part of a dozen years now, operating in North America and Europe. We are investing across financial services and into all sorts of interesting embedded finance spaces. And looking forward to the conversation.
Thanks, Jens.
Sorry for that. Jens Robert, my name. I'm the founder of Banxwave. We're an embedded lending provider, lending as a service provider, based in Berlin. We're live in Germany with a number of platforms where we offer our first product, which is an embedded merchant cash advance solution. My professional background is I'm actually a lawyer, but I was in the fintech space since 20 years, served on the board of PPRO for 10 years, worked for numerous payment service providers, and came about the idea of an embedded lending product before embedded became kind of a buzzword, and we called it a white label merchant cash advance solution at the time, and that's what we built. And then I think it was Andreessen Horowitz who named it embedded, and I think it's pretty point on. So that's what we do. Thank you.
Thanks. Joe?
I'm João, CEO of Lovys. We are an insurtech startup active both in France, Spain, and Portugal. Our value proposition to the end user is to provide an all-in-one insurance solution. So we typically say, think of Spotify to protection, so that you can protect your car, your home, your cell phone, or pet, and pay a single monthly subscription. What is interesting is from a distribution standpoint, we do the normal B2C, but we also very strong in partnerships and embedded insurance.
Thanks. And last but not least, Hugo.
Hi, everybody. I'm Hugo Bongers. I'm responsible for ABN Amro Ventures, which is the corporate venture fund of ABN Amro Bank. We are a 150 million operation. I've made 19 investments, 4 exits over the last 5 years. Look in fintech, enterprise SaaS, Europe and the US. And I think in the embedded space, we have done a couple of investments like Tink, Solaris Bank, Upfest. Please reach out via the chat or anything else. Let's hope to make it as interactive as possible in a digital way.
Perfect, thanks. And so thanks so much for joining, all of you. I think to kick things off, to maybe set the scene a little bit more after Lorenzo's introduction, Matthew, I wanted to go to you. So Anthemis have been interested in embedded finance for quite some time. You, I think, published a white paper in 2019 where you described it as the future of the economy. I'm interested in what interested Anthemis in embedded finance, and also what's changed since 2019.
I think so we were talking about it a long time before 2019. I think it's just that we were so busy investing in embedded finance companies that we didn't get around to writing a white paper about it until that time. To the question of what's kind of changed since 2019, or I guess in fact why it's so important. Obviously, we believe that financial services is the lifeblood of the economy, and so we see that we're moving beyond this idea of kind of going to kind of very specific places for very specific and old-fashioned products, and this shift towards more context-dependent and customized products, I think, is a natural kind of evolution of financial services. If I think about how things have gone since 2019, I guess we've really seen it coming of age almost. Previously, these products were kind of adjacent. Now they're more context relevant, and in many ways, I think we probably used to just call it affiliate marketing, right? Sending someone to somewhere else and sending to a different workflow and getting them to either buy a product or where they need to actually a different place entirely for them to conduct a transaction. And now we're talking about far deeper integrations. In our portfolio, for example, we backed Hakodo, which is a B2B buy now, pay later platform that sits within B2B marketplaces. We backed Stable, which is embedding price insurance into commodity platforms. And we backed Hedvig, which is providing renters insurance at the point of arranging your new apartment in the Nordics. I think the difference is perhaps that this is now considered more strategic. So it's more embedded finance is coming up in more and more conversations around increasing stickiness, customer satisfaction, and reorienting the platform in question as kind of even more business critical than perhaps it previously was.
And it's interesting you talk about that coming of age and also the kind of diversity of the types of applications within embedded finance. But are there still some obstacles in place for embedded finance startups, and are some solutions easier than others?
Some solutions are definitely easier than others, and I'm sure we've got some founders on this on this call that have got some war stories that they can share about their experience of embedded finance. I think there are a couple of different angles, I guess, here to think about the obstacles. So for those that have been working on propositions that are to be embedded elsewhere, getting to the top of the agenda of the people that you're trying to work with can be quite a challenge, right? So you're often just trying to keep the lights on, even if this kind of embedded finance proposition, like an insurance product, for example, even if it's super relevant and interesting, it can be sometimes quite tough to get everyone on board. And then if you're one of the platforms that is looking to embed a financial services proposition, getting people to believe that that's the right place to engage or to buy, or that it works, can be really tough, especially if that product has historically been advised, for example. It can be really tough to stop people thinking, I'll just go back to my advisor or my broker and ask them a few questions. But there's also the volume question. So, and that applies to both of these groups. Is this something that enough people will opt into, or to make it worthwhile from an effort perspective? It's great to take a few pennies of a transaction or a few % of an insurance commission, but if the attachment rate is really low, that can make it really difficult for the business case to stack up. And then I think the final thing that comes to mind is the kind of regulatory and legal perspective. The shadow of PPI, I think, still hangs over a lot of organizations in the UK. It was a real issue for the industry, this kind of idea of embedding. I appreciate that it's not kind of traditional embedded finance, but this idea of kind of embedding products that people aren't totally sure about, it can be particularly, it can put people off. It can be particularly challenging. So I think people are also cautious about getting caught up in issues there as well.
Interesting. Yeah, I just want to touch on regulation in a little bit as well. But Jens, I wonder if does any of that resonate with you, and what have been some of your biggest challenges to date, or that you see going forward for Banxware?
Yeah, I mean, I think it's really spot on. You embed typically in a platform with an offering that is for a platform customer. So you have a B2B2B approach, meaning you have to satisfy the platform, and then you have to build a product for the platform that is attractive for the platform customer. So it's not kind of it doesn't follow a cookie cutter scheme, because each platform is different. It has different platform customers, different merchants behind it, and different merchant cohorts. So what we tried to do was to build kind of a one size fits all kind of product, learning that e-commerce platforms work entirely different than payment service providers, from a compliance, regulatory, and legal scheme, from a user experience scheme. And you find yourself very different stages of, I would say, legacy technology that you find at these platforms. So many of these platforms have tremendously antiquated technology, which makes it hard to embed. Some have very low digital interaction with their platform merchants, which makes it hard to reach these merchants. So all these are issues and obstacles you're faced by starting to roll out the product. And I think we're still in this phase where we're trying to tackle some of these challenges. But I think what I can say is there is a very big demand for embedded products on from platforms of all kinds, and we see platforms that are where the platform merchants generate revenue over the platforms, e-commerce, payments, that kind of stuff, and we see platforms which are more closed platform ecosystems where they have a huge amount of customers, but they sell them goods and services. So they're looking for a buy now, pay later, or a factoring product, or a credit line, or term loan arrangements that they want to embed in their platforms. So at the end, I think we found ourselves in a more diversified environment that I originally thought we would find ourselves in. But I think we've kind of built a product that's now kind of serves as a common denominator for these various platforms. But I can totally second that. It's not something that is I guess super easy thing to do. And lending on top, what we do is we said, let's start from the platform customer side. Let's give him the best user experience he can have. But at the same time, we want to satisfy the platform. The platform is only happy when the platform customer is happy. So it's really something where we realized we have to make it as easy as possible for the platform. And we have to bring everything that's part of this whole embedded financial services supply chain to the table. So in terms of lending, we bring the money, we bring the onboarding, the compliance, the KYC, the scoring, the credit decision, the loan management, collection, everything. So it's really an easy way for the platform, so they don't have to engage other service providers, but integrating access platform data and making the platform engage with the customer to market this very product to the customer. That's where we see the challenges these days, and that's where we're working on improving it. And I think we're in a pretty good way. But to your point, Matthew, it's not like a super easy thing.
Cool. And Joel, it's interesting hearing about the platform, the challenges with the platform providers there, because Lovys is foremost a kind of direct-to-consumer brand, but you've increasingly been focusing on embedded insurance offerings as well. So I wonder, why you decided to move in that direction, and are you kind of feeling some of the same pain points as well, I suppose?
I mean, I think for us, we felt it from day one that was something natural. So, I mean, it was something that I have already previous experience from a previous startup that I did in Brazil. So it was something that it was clear to me that we should leverage on B2B2C and on partnerships and embedded to really make it another channel for us. I think it's very interesting because when we look and we use the word embedded insurance, I think it's important to provide here a framework, because I think we call the same name for different shapes and forms. So I think within embedded, I think it's important to differentiate 3 different types. One type is the sort of, I would call it cross-selling, or I would nickname it cross-selling. It's like you have a bank, that bank has hundreds of thousands or millions of clients, and you facilitate the selling insurance to those neobanks. That's something that we are doing extremely successfully. I mean, like in France, we have some of the very largest neobanks, like Ma French Bank, Flow, that is part of BNP Paribas, Carrefour Bank. Then you have the second group that I would call on the checkout process. So let's imagine someone that got a mortgage, but as part of that mortgage, they need to buy an insurance policy, and you facilitate that process. I mean, so it's really part of an ongoing sale, and that works extremely well. We have some excellent conversion rates on that, and we work with mortgage providers, we work with real estate agencies, we work with some extremely large moving companies as well. And then you have a third group that I would call inclusion. That is the more recent, in which the insurance part is actually part of the product. And I find that extremely exciting. For example, we are doing a partnership with a monthly car subscription company. And there, I cannot say that the insurance itself is really the product, or is really a key component of the product. So I think it's important to give this step back and really understand that there are, within embedded insurance, three very different animals that I would nickname them the sort of cross-selling, the checkout, and the inclusion type.
And you also don't white label your product, but when you're partnering with these companies. So I'm kind of interested as well in what kind of impact that's had on your brand, and also what kind of things you've learned through those partnerships that you're able to then feed into your D2C offering.
So, I mean, I think one of the elements I think it's very important to highlight is that actually we went to this market with a slightly different approach. Is that from day one we said we are going to do it, but we are not going to do white label. So the client at some point, they see the brand of Lovys. And what we find, and for us, the interesting element of doing this is that we are a B2C company, and we see that it's great to actually put our brand because it facilitates and gives more credibility to the sale. And actually, afterwards, that client has the Lovys app, and we see that we have a quite high rate as well to maintain an engagement with that client, even if the client bought 100% from the portal or another client's website, and the cross-selling of additional products to those clients is quite significant. So we find very interesting that not only through embedded insurance we sell, we onboard more clients. In the end, we have an expression at Lovys that we are not interested in using embedded to make sales, but instead to earn clients with that. Because I think that was a problem with embedded in the past, is that people really were monetizing that sale, and therefore they needed to have a very high margin. In our case, our ultimate goal is not that sale in itself, but it's how that sale becomes part of a conversation with a client, and how we can become really it's like you share a song with someone, and that person starts using Spotify. I would say that is the same thing. What do we want is that embedded to become that song that you share, and that we are basically the Spotify, your account for managing protection. And that is actually working. That's really fascinating.
Thanks. And Hugo, so you're from ABN Amro Ventures, the venture arm, but equally connected to ABN Amro. And I'm kind of interested in, what do you think? Are the other banks getting worried about these startups like the ones we've got here? And are they worried about finance moving away from banks?
I think, let's say, I'm a strong believer in the partnership route. So banks can play a role here. Fintechs can for sure play a role in the end to enhance a better product and a better user experience to the end customers. So, for instance, I strongly believe, let's say, what is a bank able to provide? That is, for instance, capital, a balance sheet, and maybe a value add to banks who are on the risk scoring side. I know that, let's say, our systems are not the most agile ones, but there is 200 years plus in risk and history here. So we can help these companies. And so have we done, for instance, with Solaris Bank, in helping their risk policies and giving them a head start there, helping them with capital, etc., and knowledge. In the end, it should be about the partnership going forward and not the banks only going forward. And yes, there are things where the fintechs and the tech companies are much better equipped than we, but you have something else to bring to the table.
And should the startups be worried about the banks kind of creating their own in-house solutions and copycat solutions, things like that as well?
I think the big question is, if you look at tech companies and the massive amounts of funding that go into that, for banks it can be challenging to have like the stamina to have a 5 or 10 year horizon to be there. And for instance, if I look at Solaris Bank, they've raised over 350 million euros. That's quite a heavy amount, even for a large bank, to put in a BaaS offering to develop themselves. So if there's a specific niche where banks have specific knowledge, then yes, of course, there can be a reason. But for corporate ventures, internal ventures to last, there needs to be a long-term senior commitment in money, time, and people to make it happen. In the end, we are a bank. We're not a software company. And it's a big fight if you want to take it up against Solaris Bank or one of the other many players around. That's a big fight to take on. So let's work together instead of fight till we die.
And Jens, so from if we look at some of the other forms of lending that startups have kind of been innovating in, you could kind of see there's been a couple of areas where there's maybe been a bit of a struggle. Areas in kind of peer-to-peer lending had a bit of a tough time. Buy now, pay later as well, to an extent. People getting a bit worried about that now. Is there a differentiator with embedded lenders that where you think that they can kind of avoid those kind of risks?
Yeah, I mean, that's a good question, and it's maybe a little early on to really say. If you look at the landscape of these, I would say, new lenders, such as those who do revenue-based lending, particularly to e-commerce merchants, they try to avoid historic data and take another approach on the credit decision. Say, if I have to review historic data, it requires a manual process. Let's look at the recent revenue trajectory through as many sales channels as possible and determine on that basis, and then enrich that data with third-party providers through open banking. And I mean, that's essentially what we do. What others do, I have not seen others embed with this kind of product. There's direct to merchant offerings out there, very crowded market in the UK in particular. But I think it's the combination. When you look at the platform and you see the platform where you embed this merchant develops in a certain way, it's pretty likely that he will continue in this trajectory. On that basis, you can lend. So currently in our setup, we can make that credit decision, gather all the data, and wire the money within less than 15 minutes from when he starts his application. And if we approve the credit decision, 15 minutes later, he has the money in the bank. So it's extremely fast. It's extremely efficient. The platform revenue is really, we look at 6 months, 6 consecutive months prior to the credit application, and we want to see a certain trajectory there. We enrich it with other data. So we take a totally different approach than what traditional lenders are taking, which is looking at 2-3 years historic financial data. I think we're going to end up in a similar default rate eventually than the traditional lenders would be, which is like a low 1-digit % amount. You will always have that, but I would not generally say it's a higher risk approach. It will not lead to higher defaults. I think rather the opposite. It's when you're embedded in a platform, and the platform is your main interaction point where you make your revenue, where you look at your financials, your liquidity, and everything. This is also where you want to have your loan product, and that's where we go. And there's always going to be a certain risk involved, but I think it's open data. Open banking gives you access to data that can prevent these risks you would otherwise have.
And Zhao, so Jens touched on the kind of speed and ease parts there that are kind of big upsides for consumers with embedded finance. But are there what kind of risks do you see? And kind of touching back to what Matthew mentioned there, are there things that you think regulators are going to be starting to look at?
I mean, I think there is clearly a major concern that is there is embedded insurance. I think there is also embedded stealing. I think PPI is the most well-known example of embedded stealing. I think, unfortunately, there are still a lot of embedded stealing around. And what I mean embedded stealing is when you see an insurance policy that is being sold, in which the ultimate value proposition to the end user is extremely weak. I mean, and even recently I saw a neobank that is selling a smartphone insurance policy. I mean, that the characteristics of the product are just insane from a value proposition for the client. I mean, saying that they are basically, that product is ultimately a fraud. And so I think that's the ultimate risk in embedded insurance, is because for many of the companies that are teaming up to sell those products, what they want to do with insurance is basically enhance their margins, because they have a lot of pressure to monetize their user base. I mean, what we have defined at Lovys is that we have a clear red line in terms of what for us is insurance products that clearly have a genuine value and intrinsic value to the end user, and some that for us is just like what we nickname as embedded stealing. But ultimately, I think there is a lot of value to be created. I think, and as I mentioned, I think one of the things that I find that are really fascinating is the inclusion in which the insurance is really part of the product. I mean, we have several projects at the moment on that direction. For example, we are working with two major classifieds portals, in which what we are doing is effectively helping with some insurance products transition that classifieds companies to go into a more sort of marketplace strategy, in which you are putting some insurance policies on top of that to give the level of comfort on the transaction that they expect at the moment from a marketplace and they are not used to have from a classifieds company. And that, I think, is fascinating, because it's really you are really providing something unique and worth mentioning in a way.
And Matthew, on that embedded stealing, do you feel like there could be kind of repercussions, at least in terms of for the rest of the industry, in terms of trustability or reputation?
I think so. I think after PPI, I think a lot of companies are very aware of the kind of both the letter and the spirit of the rules. And so for example, across our portfolio, companies are, a compliance hire is something that happens very, very early on in the development of the company. And so it feels as though companies are unlikely to fall foul of the kind of strict rules that are in place. But I think you're absolutely right. It is about reputation. It's about being perceived as being trustworthy, and kind of providing good value. So I think it's more about that than kind of the rules, if that makes sense.
Yeah, and we've heard a fair bit about lending and insurance now with the panelists here. But are there areas in embedded finance that you think are still overlooked?
So let's maybe start briefly with insurance. There has been a lot of activity there. I think it's only now probably just about getting going. Before we were thinking about it in terms of using data that's coming through to auto-complete certain forms. Now I think people are going further in using the data and the contextual data to better underwrite in real time, for example. Elsewhere in our portfolio, we have a company in India, in fact, that is called Loconav, that provides an ability to their customers to pay tolls and taxes and administrative fees, as well as get access to other products. And so I think that's an area that we've been particularly excited about, especially as government infrastructure technology infrastructure has improved, and it's become easier to interact with local authorities in a digital way. We have a company in the US called Axel that does factoring. So they work with freight brokers to turn invoices into working capital, and That's all embedded within their SaaS platform. And then I think the last area that really comes to mind is probably hedging. So thinking we have a company that is working on embedding hedging products into energy bills to help consumers better withstand the kind of fluctuations that they are encountering in the bills that they're getting. And I think we all read the news, and I think that's going to become even more prominent over the next 6 to 12 months. So I don't think anywhere is, you asked a very simple question and I gave a long answer, I apologize. I don't think anywhere is really overlooked now. I think it's just that we're advancing and we're kind of moving forward and becoming perhaps more sophisticated in how we think about these products and where they're embedded. You're on mute, Orla.
Oh, thank you. Well, there's always got to be one, isn't there? We're happy to take one for the team. Hugo, I was going to ask you the same question, really. From your perspective, are there areas that that ABN Amro Ventures or banks in general are kind of getting particularly interested in?
I think I would adhere to what Matt has just been saying. I think it's generally a couple of years ago, it was embedded finance as a whole, but you now see slicing and dicing of the different verticals within finance. So banks are offering embedded lending, you have embedded hedging in energy contracts. We are a strong believer of embedded investing or embedded trading. So every slicing and dicing you see, let's say for me, the best of breed solution, that is very attractive, but you need to see how big is the total addressable market in the end. You can slice and dice it as tiny as you want and then be the best in microfinancing in a small town in the Netherlands. But in the end, there needs to be a VC case as well. And offering the best product can be niche, but it needs to be big as well. So that balance, that is interesting to see. And I think we're only in the beginning, in the first innings of people first trying to offer their embedded X, Y, Z to more early stage companies, and then in the end grow into offering embedded solutions for larger corporate customers. And it's only early days for all the slicing and dicing, and also for the growth into the large corporates.
And when you invest in startups and like Solaris Bank, Upvest, is it a purely investment? Is it a pure investment, or are you also looking to kind of partner with the bank as well and kind of find areas to work together?
I think it should be both. And there also should be a clear reason for tech companies, for startups, to take our money. There's so much money floating around. Depending on the market changes as we see it happening right now. But what do you add on top of the money that you bring? And we can deliver the bank plus our network. But it should be very clear what we can add. And it can be about our customer base. It can be about the balance sheet. And it differs per company, per life phase, what we can add. But clearly, there needs to be a VC outcome as well. There's nothing strategic in making investments in companies that go bankrupt or that don't deliver a good return or should deliver a good return. So it's always the balance. That's how we look at our portfolio and also in making new investments.
And Matthew, I should have probably said congratulations earlier, because you guys raised a big new fund at the end of last year, $700 million. And I'm interested in is there a new or evolved investment thesis you're going to be looking to spend that on?
The way that I would characterize our investment thesis is at the core of it, we have new banks, new insurance companies, traditional fintech propositions. But then around the edge of those, we also actively invest in a range of adjacent industries where we ultimately believe that the technology that is being developed there will intersect with financial services at some point in the future. And so those are spaces like energy, agriculture, climate, mobility, health, and prop tech. And so we end up investing and being involved in a much broader range of industries than perhaps our website kind of sometimes suggests. And there are some really interesting businesses, without question, there are some really interesting businesses being built in these other industries. Sometimes it's about being able to leverage the data that is being collected and then kind of funneling that into a financial services proposition. Sometimes it's about taking a product and putting it into another context or workflow. But we're ultimately looking at a lot broader range of spaces than perhaps you might think, just because we're investing in financial services. It's very exciting.
Cool. And I'd love to just take a few questions from the audience now as well. So we've got one here that says, it might be one for the startups, but do you think that blockchain can provide an easier pass-through technology to get around some of the tech integration challenges and automate some of the monetization in the B2B2B space? Jens or João, I don't know if you want to say anything on that.
Well, I would love if that would be the case. I think it's just still there are enough challenges technologically to integrate and to write in a kind of processor heavy solution like blockchain is going to add complexity to it. So I think we're not quite there yet. We'll see. We'll do similar ledgers that are not in blockchain, but they are kind of tracking, trying to prevent fraud and falsifications. But I don't see that going there quite yet. But I'd be really interested also to hear what Matt and Hugo have to say, because they see probably a wider range of things than I do.
Yeah, but I fully agree with you, Jens. Yes, maybe, but not for now on the blockchain topic in embedded finance. Maybe, yeah, if you look at slicing and dicing, what we discussed earlier, embedded digital assets or embedded crypto, yes, then it becomes relevant, but otherwise more mainstream embedded, not yet. I mean, on the other hand, if there's somebody in the audience that can prove that I'm wrong and that has a great offering, more than open to hear the solution.
Yeah, I was just going to say that I think some of the blocks and the concepts of blockchain are interesting, notably smart contracts. So the notion that there is a if-then, so if there is a certain event, there is a payout. And I think that's, as a concept, is very interesting from an insurance standpoint for all the parametric and so on. But the reality is that the same outcome or the same logic can be replicated without using blockchain. And I think at the moment, given the complexity around blockchain, we are doing some of that sort of if-then clauses, but without using the underlying blockchain technology, just because we see that at the moment is not making things easier, but rather opposite.
And one more from the audience then. So we've got, we see many new players emerging in the embedded finance market. What are in your view, makes some of these stand out? Hugo, maybe you want to jump in on that one?
I think in the end, it comes down to management and execution. So especially if you start early in the embedded, somewhere in the embedded finance world, what is the game that you want to play? Do you want to offer services to tech companies or early stage companies, as discussed earlier? That's relatively easy. That's low hanging fruit. If you go and partner with more legacy platforms, legacy companies, larger corporates, then it can become painful. But that's also where big markets are. So, but there will be a lot of more companies, a lot of more growing companies, but it is also getting crowded here and there. So and there won't be room for all embedded finance players in 5 years' time.
Matthew, for you, what makes something stand out?
I think Hugo is absolutely right. It is about the team, and I think the other thing that I guess I particularly like is when it's a kind of core part of the strategy, and rather than just a kind of add-on or something that kind of people resort to when they feel like they've run out of other options or when they want to pivot from another kind of strategy. So when it's really kind of been well thought through, and when the team has got a kind of deep understanding of how they think that their products or service will work in that context, I think it works really well.
And what about as well, maybe other types of tech companies who are looking to verticalize and start integrating embedded finance into their offerings, things like marketplaces? Are they going to be kind of emerging as competitors to both the kind of fintech startups and the banks? And how do we kind of see that balance playing out? Matthew, maybe for you.
I think some of them initially will try to do a lot themselves and they'll experiment. And I think they'll realize that a lot of it is a lot harder than maybe they originally anticipated. I think a lot of companies, it can sometimes take a lot of throat clearing and a lot of time for them to realize what their superpowers are, and that maybe, managing a panel of banks or a panel of insurance companies in the background to provide a certain product isn't necessarily what they were kind of put on earth to do. And so, we've seen that here and there. And I think there are other things like, I think a lot of people underestimate things like, evaluating credit risk. I mean, these startups that are purely focused on embedded finance, that's what they do all day, every day. And the idea that you can just spend, a little bit of time here and there and throw something at the platform and see what sticks, it doesn't really work like that. So I think some of them, how I kind of think it might play out is, I think we'll have companies try to compete a little bit at the beginning, and then they'll kind of realize that partnering with maybe some specialists is for the better towards once that's kind of played out a little bit.
Jens, is that something that you're seeing as well? Because kind of lending is one of those areas that others might be kind of
yeah. No, I mean, I think Matthew's absolutely right. However, I don't think it applies for each of the embedded verticals equally. I think lending, insurance is something where they reach out to the specialists. But what we saw that over time, a lot of the platforms were driven into payments and more or less coming from the regulatory side. So just using a third-party payment service provider, it puts a lot of restrictions on a large marketplace. So they went and got their own financial services license, their own payments principal memberships, and now have small fintechs in their teams. And then there are others, like you see, used car marketplaces that run their own fintechs with the purpose of not just selling you the car, but also bring the financing to the table. And you see that they struggle quite heavily, because it is a risk-driven risk assessment business that is tailored to a specific merchant cohort. So I think with lending and insurance, we're on a pretty safe side that very few of the platforms will try to build that as a proprietary core solution.
I fully agree. And if you look at also Apple partnering with Goldman, Amazon with Citi and other big banks for balance sheets and cards issuing even, do what you're best at in the world. Focus on that, and don't be, especially for a tech company, don't be distracted by regulatory, balance sheet, credit scoring, etc. It can be painful.
I think we've just got time for one last question, also from the audience. So maybe a practical one. When you're in a country without regulation for fintech, even if embedded finance is not, that bit doesn't make sense, what would you advise to launch anyway, basically? I guess the rules of play in somewhere like the UK might be quite different from somewhere else in the world. And I don't know if you guys have insight into how you go about that, basically.
I mean, I'm not sure what's meant by regulation for fintech. If you mean if there's no open banking, then you find yourself with a challenge to find a unified solution to access data in an easy way. There are countries like Turkey, for example, that are on the verge of launching an open banking unified API system, but it's not there yet. If you mean a country without regulation for lending, there are certain exemptions. In the Netherlands, for example, lending to businesses is still unregulated. Same in Poland and so on. And clearly that is something to go for and something to embed. But without the open banking standard, I would find it really hard, I must say, because the user experience will eventually suffer.
Mm-hmm. And we're almost out of time, but I'd like to just maybe ask each of you if you have a prediction of what might happen in embedded finance in the next 24 months. And yeah, you can be as bold and ambitious as you like. But Zhao, maybe we'll start with you.
I mean, I think in insurance, what we are seeing is really unprecedented, and we feel that at Lovys, like with very large firms. I mean, some of the partners that we have done, like Carrefour and others, really show the momentum. So I would say that within 24 months, we'll see that pretty much all the major marketplaces, retailers, will have some sort of really insurance is part of their roadmap, and I would see that they will have at least a basic offering within 24 months.
Jens?
Yeah, I would say the same applies here in Germany for the lending space. We have the largest payment service providers catering to SMEs here under contract, not live yet. They are yet to prove that they can reach their customers and turn their platform merchants into borrowers. And I think the way this will work is that the embedded solution will move more into the prime real estate of the dashboards of where customers interact. The B2C is probably the checkout, and the B2B it's the merchant dashboard where they see when are my revenues coming, when is my next settlement, and here's also a lending proposition. So it will all converge into somewhat of a liquidity planning tool, at least for the lending space. That's my take on it.
Thanks, Hugo.
It's for sure about growth in the whole embedded finance space. It's about slicing and dicing, but it will also be more business case driven, looking at the end customers and the end users, given the macro uncertainty that there is right now. So less innovation theater, more business case driven, I would say.
Okay.
And customer value driven in the end.
Nice. And last word to you, Matthew.
It's hard going last after those. I think I completely agree with all of those. I think here's a prediction without being a prediction. I think this is going to be some twists and turns that we don't expect in this space. I'm really excited about that. But I don't think it's going to be a kind of straight line up and to the right. I think it's going to be some twists and turns that are going to make this an exciting space to be involved in.
Okay, awesome. Well, yeah, looking forward to the next 24 months in that case. But thank you so much, all of my panelists for joining. For those in the audience, the networking area will be open for the next half hour on the left of your screen. You should be able to find that. And thanks so much for joining this Dealroom Talks event. We'll be following up with all of the slides as well, and we'll can upload this to YouTube and rewatch again. But until next time, thanks for joining.